What's going on, guys? Today I want to talk about one of my favorite strategies trading in the stock market. It's a strategy that I use to create a weekly and monthly income from a relatively small amount of capital. This can be used if you have $1,000, $100. Probably the minimum would be $100 is the minimum you can get started with. But I mean, it's definitely scalable to however much money that you have. But yeah, the strategy is called, a vertical spread. The particular one we're going to be talking about today is called a put credit spread. It involves selling a put and buying a put beneath the original put that you sold. So the ETF that I'm going to be talking about today is called SPY. It's a S&P 500 ETF. It is a very popular ETF among the stock market. So there's a lot of volume that's being traded with this stock every single day. So yeah, let's go ahead and jump into it. For this type of trading, you are going to need at least level 3 options trading. That involves a couple different applications that you have to fill out with your broker to get approved for this type of trading, because it is a more advanced type of options trading. So let's go ahead and jump in here. As you can see, it is October 9th today, and I'm looking at the SPY ETF for expiration dates of October 16th. So what we're going to do here is, the put credit spread is a bullish play. You actually benefit from the time decay in the put option you sold. Plus, any movement, upwards, or, even if it trades flat, even if it goes down a little bit, you are going to still benefit from this strategy. So, a lot of times people will struggle with, picking the correct direction of a stock or an ETF, commonly known as like buying calls and buying puts. They're great when you're right, but when they're wrong, it definitely can go south really quickly. So, with this strategy, you're selling the option. So it's kind of like you're the casino and you're benefiting from the time decay. Okay, so what this is going to involve, so let's say, well, actually, this is what SPY is currently trading at, as we're in the middle of the day here. But let's just say we're bullish on the stock, and we don't believe it's going to drop. We just believe it's going to go flat or continue to go up. So what we can do, you can see here I have a couple already working for me at the moment. But let's just say we're going to sell the 343 put and buy the 342 put. Okay, so what does this mean? So this means that my minimum credit is going to be $28. So that is the most amount of money that I can make from this trade. With this type of trading, it's a more conservative approach as far as you're capping how much you can make and how much you can lose. So, that's different with regular calls and regular puts. The profit potential is unlimited. But with that, there's a lot more risk as well. So in this scenario, it's typically the strategy, if you didn't do a spread, it would just be a cash secured put. And that is another great strategy. But the problem with that is that in order to sell this cash secured put, you have to multiply the current strike price times 100. So that would be $34,000 cash that you would have to have in your account in order to sell this trade, which, a lot of people don't have that. So with the spread, we're pretty much offsetting the collateral required by buying a put right beneath it, right here. Okay, so the minimum amount of credit is $27. The collateral required, so you must have at least $100 in your account, or have $100 worth of margin. And that is how you can calculate that, is the difference of these strike prices. So it's $1, so you multiply that by 100 is 100. Okay, so if you wanted to make it a wider one, you would just pop that down there, and then it would be a 2-point wide spread. This is not right. Let's see. come back here. So we're going to sell the 343 and buy the 341 for a credit of 51, and the collateral should be $200. Wow, Robinhood is taking its time. But yeah, I mean, so that's pretty much the concept of it. Okay, there it is. The collateral is $200, and the minimum credit is 51. So as long as SPY trades flat, or it goes up, or it can even go down a little bit, this is where your max loss could happen. So a great website you guys can check out, I'll put it in the description below. It's called optionsprofitcalculator.com. But if you insert these, they have a chart, and they do a great job of explaining, where you'll make your money, where you'll potentially lose the most and whatnot. But pretty much, as long as it stays above 343 before expiration, you'll be good. You'll get your max credit. However, I definitely recommend closing your spreads out before the expiration date, just because there's always a possibility of one of your legs getting executed and not both of them at the same time. I know there was a situation with someone on Robinhood a couple weeks ago that he held his contract through expiration, and one of his legs executed, and by the time he could do anything, it was Monday the next morning, and the stock actually ended up dropping by $20. So he was in big trouble. So yeah, always close your options before expiration. It's just best practice. You're just taking a lot of risk off the table. Yeah, you might miss out on a couple of dollars of the profit, but I'm telling you, it's definitely worth it. Just close it out early and move on to your next trade. Yeah, so a couple other things I want to mention. Definitely trade a stock that has a lot of volume, just because if you want to get out of a trade and there's no volume for that contract, I mean, you might not even be able to get out of it. So just be really careful trading, stocks and ETFs that don't have a lot of volume. As you can see here with SPY, it has a lot of volume and a lot of open interest, so that's a good thing. So yeah, I think that's the basics for a put credit spread. Definitely leave it below in the comments if you have any questions. And once again, this is not investing advice. Please do your research before doing any type of trading or any type of investing into the stock market. Learn what you can from this video, and then go educate yourself some more. But the best way that I learned was just trying it out. Just doing a couple little ones at first. Just understanding how to get in and out of a spread. Because that can be a little bit complicated, and the best way to do that is just to learn from experience. But yeah, I think that's it for this video. I hope you guys enjoyed it, and feel free to hit that like button if it helps you out at all, and feel free to always leave comments below with any questions or concerns that you guys might have. All right, thanks again.